And we're here again to talk about topics that's really relevant to you. And I want you to know that every time when we come online, it is not some topic we talk about. It is actually your topic we talk about because we know that's what you are asking. That's why we always come online and to address what need to be talked about urgently. So recently, obviously, it's a 1040 filing season. People start looking at their numbers and they come up with, their return. And when they are doing it, they look at their 1099B, the investment statement. They know that they didn't make any money. They lost some money. But then again, all the losses is not allowed because they're wash sale loss. So suddenly, and they go onto the internet, they look at things and what to do. The internet suggests that, hey, you should do mark-to-market election. There you go. We got calls. People will say, Ying, can I still do mark-to-market election for 2022? I didn't know anything about it, and I didn't do my election. Now, what is my option? So let's talk about what's your option today. And, let's go through our quick routine for all the webinars we do online. There's so many ways to reduce, to do a tax deductions. It is not like a straightforward just one way. And if you are really into tradings, then maybe you already have an LLC and maybe you already did something that you are just not aware that can be used for tax deduction. So you can subscribe to our channel. That would be the best way to know what's going on. So this is our topic. Can I still elect mark-to-market trade losses for 2022? So obviously, you're thinking about mark-to-market because you had a loss. Right now, if you don't do mark-to-market for security trading, you can only deduct the $3,000 loss. You may be losing $3 million, but that does not come out. Even if you made a $3 million W-2, you lost $3 million in trading, but because you didn't do mark-to-market, you can offset these two numbers together, and you're really stuck with your W-2 for $3 million, and you can only deduct $3,000 losses. So you might say that, well, what do you mean? Are you saying that even till I die, I'm not going to be able to deduct all of the losses? Well, if you don't do anything anymore, and you don't do any tax plan anymore, and you don't do any business anymore, and you have no more gains ever on the capital gain side, then of course that's the case. But of course life goes on, right? So you learn your losses, and maybe next year it comes back, so it will absorb your losses, and you're not losing the wash sale loss. And in my slides, I will explain to you with numbers so you get what I mean. The wash sale loss you do not deduct. That does not mean you lost it. It only means it got delayed. But you want to write down the loss this year. You don't want to wait. That is what happened to people want to do mark-to-market. Is mark-to-market the best way to handle capital, handle your security losses? I would not say yes. I would say depends. So that's why we want to discuss about this, just to give you a more clear, a bigger vision of how this rule plays out, right? Instead of you just knowing that I need mark-to-market so I can write off my loss. But what if the gains come back next year? Those are regular gains. It's going to eat you alive too. So think through it and knows the strategy that works for you. No responsibility disclaimer, that's always there. And you want to take knowledge on internet, free knowledge on internet with a grain of salt. And do not just do serious stuff and without knowing where the knowledge is coming from. If you really were going to make a big decisions, and I want you to consult our firm to get that nailed down before you do it. All right. It is really important to know you are a trader or are investor, okay? And when you are an investor, what you're saying is that you are passive. You are actually just making the passive income, the income you make, it is not subject to self-employment tax, and you're not in business, okay? You are just an investor. But in our talk here with the securities, with the online tradings, if you are a trader, that means that you are in business. And that is a condition of mark-to-market. You must be a trader. You must be a day trader. And there's no black and white hard definition that you're going to draw out IRS book. But generally speaking, based on the court cases, and the IRS is looking at your trade frequencies. They want to know whether you are sporadically trading or you are frequently, regularly, and continuously trading. And then they also want to see whether most of your trades are short-term in nature, like you have a lot of trades that happens within 30 days. So if you are a regular investor, that would become a wash sale. But because you are a day trader and you elected mark-to-market, so those frequent trades will be income and losses, and it will be counted as your business income. To get there, if you are a trader and you want to run your business like trading and forget about capital gain, capital loss, and then you would do this mark-to-market election, that's called Section 475 election, okay? That election basically converts your income and the losses in security trading to ordinary income and losses. And any opportunity to defer income recognition is eliminated. So like, no, you're going to recognize income losses immediately. And, even if you don't trade, by December 31st, your year end, and whatever market closed down, that is your number. So it is like you can really hold on to the position and trade later to next year, then recognize capital gain next year. That is an investor position, not a mark-to-market position, okay? And the limit for capital gain loss deduction, we all know, is $3,000 per tax year. And then, of course, if you want to recognize the losses, you need to finish the trading at the end of the year, right? If your trading account, sometimes maybe you're with a TD Ameritrade, maybe you're with Robinhood, you need to know when is their last day of the year for trading for them to count. May not be December 31st, it might be December 25th, okay? So that day trading, after you did the trading, that's how the calculation began to see what is your total capital loss or capital gain. And generally speaking, there is no limit in losses when you are in business. So if you have a mark-to-market elected, there is no limit. And you don't worry about $3,000 loss deduction. You can basically deduct whatever losses you have. All right. So basically, all you need to remember is mark-to-market election is only needed for securities. If you do options, if you do cryptocurrencies, those are not securities, so mark-to-market doesn't apply to that. And mark-to-market only apply to stocks, the securities that you're doing. So this slide is giving a little bit of background of mark-to-market. And how, I want to kind of show you a slide where I calculate the mark-to-market gain and loss. And in the slides, I also have a little section I want to show you. The red part of that section right now you're looking at, that is the investor position. So let's say if you didn't do mark-to-market and you're still trading like an investor, then how is your book look like? So let's look at this example. On January 1st of 2021, I'm just picking a year, ABC stock, 1 share for $10. So on that first day, you have 1 share for $10. On March 1st, the same year, and that stock went down to $4. So you sold it for $4. So stop right here. So if you are a day trader and you have a mark-to-market elected on your book, you have a loss of $6. let's pretend that this is the end of the year. Then you will have a $6 as a loss on your tax return to offset the W-2 you have for the year. So that is your mark-to-market position, trader position. But let's say it is not mark-to-market, it is an investor, then you have a short-term loss. Short-term loss means you didn't hold the stock for very long and just about 3 months. You sold it and you lost $6. So on your Schedule D, you're going to put in January 1st, I bought for $10. March 1st, I sold for $4. Short-term capital loss, $6. That's what you're going to put in. That $6 can also reduce your W-2 because it didn't go over $3,000. Makes sense, right? So that is the position right now. So let's say on March 10th, and the stock started to bump back, and you bought back for $7. Let's say you did that, but as a mark-to-market, you bought $7. That's fine. That just means you put in $7. So nothing happens. It's just your cash went in to exchange for $7 stock. But if you are an investor right here, because you bought back within 30 days, so you triggered wash sale. So look at my red part of the writing. Your $6 loss now become wash sale loss, and it's not allowed to be deducted, and your stock base now is not $7 you paid for, it's $7 plus $6, so your total stock base is $13. See, that is what in the brokerage account, the broker firm, they track that for you. So they know they disallowed you for the wash sale loss, but they put that loss on your basis in the stock. So you didn't lose that value. This is where I try to tell people that the wash sale doesn't mean you lost it. The wash sale literally went back to make your basis higher. So look at this. So if we read on, so if you're a mark-to-market investor, it is treated as a new transaction, start your share at $7, right? So if you're mark-to-market. But if you are an investor, right now, on March 10th, you have one share worth of $13. So on December 1, sold this stock at $20. So ordinary gain would be $20 minus $7. That is the $13 ordinary gain you got as a trader elected mark-to-market. But let's say if you're an investor, you didn't really elect mark-to-market, then what is our capital gain? Our capital gain is $20 minus 13 equals to 7. So you only report $7 capital gain. So let's say we end the year right here. As a trader, elected mark-to-market, you would have a $13 other income to report, right? Because you also have a losses from before. Remember that $6? So you take 13, you minus $6, so you got a $7 net profit to report. If you are an investor, did not do mark-to-market, and right now you have a $7 capital gain to report. So this is where the difference comes in between mark-to-market and also being a regular investor. So assume you are a mark-to-market trader. You did not sell the stock on December 1st. And on December 31st, the last day of the year, the stock market closed all the transaction and ended that share price to be 50, not 20, 50. Regardless you sold or not, the brokerage company will report you have ordinary gain of 50 minus 7. So that's $43. But if you are an investor, are they going to do that? No, because they will hold your position all the way to next year as long as you didn't sell. So that's the difference. That is what we call the mark to market, right? Mark to market at any time when there is a triggering event, including the year end. So you want to be sure that, some people had losses in 2022. So they regret they did not do mark to market. But if you predict the 2023 stock market is going to be better, you're going to have a lot of capital gain coming out, it is not a good idea to make a mark to market. You want to see the stock going back up, and when you sell the stock in 2023, it will offset the losses, so you will be reporting capital gain. Long-term capital gain is always the best deal, right? Because it has a lower rate on the tax side, not like the short-term capital gain, not like the regular income. So now you kind of know how the mark to market as a day trader and versus you becoming just be a investor, how that works on your book. I hope this is a kind of clean example and give you a clean picture of what exactly we are saying here. Now, what happens to my losses if I elect a mark to market? So let's say you had capital loss in 2022 because you were passive investors, so you can only write off $3,000. When this year you did 2022 tax return, too bad. You make so much money, but a lot of money you lost in the stock market cannot offset your income. So you were in that position. You know that you have like $500,000 losses in the system. You don't have a gain to offset. So now in 2023, right now, and you can elect mark to market for 2023 before April 18, right? But if, let's say, you elected, then what happens to the loss you had in your book in 2022? They still going to be there. They're going to wait until you have a capital gain situation, so it will offset your capital gain. That loss can only offset your regular income by how much? $3,000 a year. So that is why I want folks to really think about electing mark to market carefully. You cannot just look at 1 year. You need to look at both years. You need to look at right now. Are you making money already in the first quarter of 2023? If you are, those money you made will not pay so much taxes because you have a lot of loss in the system. They will offset. But if you made election and you make money in 2023, you're going to be paying more taxes, and you can't tap into your losses in 2022. Be really careful, right? You hear what I'm saying. You understand what I'm trying to tell you. All right. The usual process of electing mark to market, timely electing, it is right now you elect for 2023. I know 2023 is not gone yet, and you probably goes, I don't want to elect right now. I don't even know how my 2023 would be. That's exactly the point. IRS do not want you to know the result of 2023 to make that election. You need to make that election right now for 2023. That's why 2022 election is already late. And you really do not have a way to do the 2022 election because that was due in April of last year for 2022. So now you look at your 2022 tax return, you were like, oh, I wish I did mark-to-market election. I didn't do. And Ying, what is my idea? What can you do? And can you just make some magic happen so I can deduct my losses? And I am saying that you may not need that magic. I want you to look at your 2023. Do you really think the stock market can have another loss year for you, or you are recovering from the losses already from 2022? If that is the case, you do not want to elect. You want to keep the capital loss in the account from 2022 and use the gain you made in 2023 to offset that 2022 loss. In tax world, I want you to sort of remember that what kind of losses can only offset what kind of gain. So you normally cannot promote that into a different category, okay? So capital loss offset capital gain, and the regular income losses offset regular income. So that's kind of, it's almost like water and oil. They don't mix. Even though they're all on your tax return, but they're different nature of offset. So knowing that if you have a loss in 2022, that loss by now, the first quarter already gone in 2023, your account is already making a gain. That's a good decision to not make mark-to-market election on 2022. You're late for that anyway, right? And I always tell folks that there are 3 things, regular things you must do when you do mark-to-market election. Number 1, you do mark-to-market election in April. Number 2, from May to December, and you will change your brokerage account to mark-to-market. Only you did election means nothing. Your brokerage company needs to know that you did that. So you need to inform them, tell them to change your account, and know that you don't have to change all of your account. Mark-to-market can be elected on each account. So your long-term investment account, don't touch it. Let the long-term be the long-term. So when you got income, it will pay less taxes. So you're only going to do your day trading account, folks. So that is what you will list to the brokerage firm. Tell them that this account is mark-to-market. Okay? After you did that, when you do your 2022 tax return, the number 3 step is to get your 3115, that form completed. It is not an easy form to complete. It makes very little sense if you don't do it all the time. But those are the 3 steps. And so you need to elect that in April. Between May and December, you need to change your brokerage account. Then next year come around, when you file 2022 tax return, and you want to make sure that you have filed 3115 timely. So that is your normal process of mark-to-market. So someone said that, well, I know I'm late, and last year last year April, I didn't even know I'm going to lose so much money, so I didn't really elect. But now I know 2022 is already gone. I know I lost too much money, and I really want to write off my loss, so I want to do mark-to-market, but I'm late. So is there a way to counter that being late? So I want to lead you to the last slides we have. So this particular slide says that the deadline for mark-to-market. So I explained here, just know that the April is the deadline for mark-to-market, and that the April deadline is for the same year. So right now we are in 2023, we're filing 22 tax return. We need to submit mark-to-market before April 18 for year of 2023. Okay? Not for year of 2022. For the same year. You elect for the same year going forward. So 2023, 2024, things like that. All right. So the last sentence over here also says that to revoke the election, you must revoke the same way by filing before April 15th. So that's another thing. You revoke the same year. So right now is 2023. Let's say you did election in 2022, but you don't want it anymore. Then you need to evoke that by April 2023 for the year of 2023. So that's kind of how that works, okay? And then, is it too late to elect mark-to-market for 2022? Yes, it is late for 2022. It is not late for 2023. And also, an interesting story, I have a client, and he elected last year, 2022, he sent out the election for the mark-to-market. And believe it or not, he actually put IRS address on the top left corner. He put his home address on the letter. So the election was running around the world and then came back to his house. So he came to me like 2 months after April 15 last year, told me that now what happened, I just realized that I mailed the election to myself and, it's not really with the IRS. So the mark-to-market election is what we call automatic election. It is election that need to go to IRS. IRS do not approve it. It is not like IRS has a machine or has someone write back love letter to you, goes, hello, and you got it, we got it, and you are now mark-to-market. No, there's no such a process in place. So you mail it. And so, the best advice in this case is that, you have a reasonable cause for that election went late. So you go ahead and mail it again and keep the original document just in case IRS come back to challenge you. And then you go ahead, change your brokerage statement. You go ahead, file 3115. So the other 2 steps you follow through, then you are okay, you are good. So we're saying that it is not like this election is going to have some big notification come back to you to confirm when you elected. It is an automatic election, so you just need to make sure that you have your record in place. Okay, so yes, if you have not done election for 2022, you are late, but you're not late for 2023, and you may not even want to elect that if you are in that situation. And I always tell folks that there's so many avenues goes to Rome, and you don't want to think that's the only way. If you're really stuck with a big loss on your account and you're late and you felt like that's the only way out, I would really encourage you to engage our firm, engage me, and let me look at your total situation, see whether there is a way to mitigate the loss so you don't just spit out the losses, $3,000 a year. Yes, that would take some years for a $3 million loss. I do have a client lost $3 million in 2022. Boy, he would have to live for 1,000 years before that can be used up. So that's tough. But there's other ways to do it. So late election for mark-to-market for 2022. And in this slide, I pointed out a 9100 relief form. This is a relief you can seek with IRS. Tell IRS that, you know what, I didn't really do my election timely because I wrote my address to be your address and mailed back to me, and or I was overseas in a combat zone and I just cannot do it. So if you have a reasonable cause, yes, that can be done. But I'll tell you, very seldomly, someone can get this request done. And because IRS is there losing their tax dollars, why would they agree with you to let you do the mark-to-market? IRS can simply reject your 9100 relief request by one fact. If IRS is going to lose more money because of that, they don't have to agree. IRS don't have to agree with your request. So it is a tough It is a tough uphill battle. It is not something like automatic election. You just elect and you get it. Not like that. So I would not encourage you to go for that route unless you really don't have any other ways to figure out what to do. If you felt that way already, you probably should come into Community CPA to get a consultation done one-on-one. Let us look at your situation, decide whether the desperation you experience is true, right? All right, so this is about our Tuesday today, and this is how you contact us in case you have more interesting topics, questions. You felt like I would shine if I can talk about it, and I will. And I really apologize my low tone voice, and it's just not me. But you got to stuck with me with COVID, and this is much better than not being able to talk. So I'm glad I did this session. I hope you learned something. I'll talk to you again. Bye-bye.